Hi, welcome today. We want to talk about adjusting entries, and I know for some of you this will be a rather difficult subject. It is for a lot of students. And so I want to give you a few facts with regards to adjusting entries so you can kind of get a feel for it and then look at a simple example. Facts. Adjusting journal entries, which commonly in most books are abbreviated AJE, and in magazines and things like that, so I do expect you to know what an AJE is. That means adjusting journal entry. Are necessary due to the passage of time. Books are otherwise correct. So time has changed the value of something, and so we need to bring the books up to date due to the passage of time. The books are correct. Correcting entries are where errors are made, and they follow different rules than adjusting entries. So adjusting entries are necessary due to the passage of time, and there are no errors on the books. This fact is very important. Every adjusting entry affects both a balance sheet account and an income statement account. Why is that important? Well, you wouldn't have wage expense and cash, for example. You wouldn't have depreciation expense and building, or I mean depreciation expense and say rent expense, something like this. They have to be on different statements, so on that balance sheet account and an income statement account. Account names are similar. What do I mean by that? We have wage expense and wage payable, for example. We wouldn't have wage expense and accumulated depreciation. We wouldn't have rent expense and salaries payable, something like that. That wouldn't make any sense. Okay, an example. June 1st, we purchased 100 $1 pens for cash. So on June 1st, we debited office supplies 100 and cash $100. What does that mean happened? Well, it means that we put, if this was our supply cabinet here, we put 100 pins in that cabinet on June 1st. So what did we get? We got 100 pins. How did we get it? We paid cash. That's what's reflected here. But on December 31st, I went and counted the number of pins in the supply cabinet, and I only found 60. So what happened to the pins? Well, if there were 100 to start with, there are 60 now, then 40 were taken out and used by somebody. When an asset is used, it becomes an expense, and everything else is on the right. So, adjusting journal entry then would be to debit office supplies expense and credit office supplies for $40. That's for the amount used. This updates the accounts for office supplies expense and office supplies due to the passage of time. Time took us from 100 pins to 60. This drops the amount in office supplies from 100 to 60, and this records the use of those pins. I will explain some more other examples momentarily. Look forward to seeing you in the next video. Take care.